Hey everyone, Rob B here with Rob D, and you, of course, are listening to the Property Podcast. So great news. All of you want to know what's going to happen with interest rates and inflation, because if you do, then you're going to make better decisions. So in this episode, we're going to do that. We're going to tell you what's going to happen next with interest rates and inflation. It's a must listen.
Yes, welcome to the Property Podcast. Great to have you here. This is the show where we take time out from advising a multi-million pound property fund, which you can find out more about at portfolio.co.uk, and share some of the knowledge that we've gained along the way for free. This week, we've been looking at the percentage change in broad money and future interest swap rates, so you don't have to. And you also don't even have to understand what those are. But we've been digging deep into that sort of data, so we can tell you what you actually care about, which is what's going to happen with interest rates and house prices. If you enjoy episodes like this, make sure you're following along on your favourite podcasting app. You can do that on Apple Podcasts and on Spotify. And make sure you stick around to the end of this episode, because we're sharing another resource that we've got for you that you can take advantage of completely free.
Now, Rob, would you like to buy my tea?
No, I've got coffee, I'm fine.
Well, Rob, if you have no idea what I'm talking about, then you are in trouble, or potentially in trouble anyway, if you want to buy a house in Wales. Because apparently, according to Google, Welsh people, please don't kill me, tea is house in Welsh.
Potential hilarious misunderstandings there. Well, I am officially locked out of buying in Wales then, because before this podcast I spoke 0 words and now I speak 1, apparently. But yeah, I've just seen this story. Landlords in Welsh-speaking communities may need to prove they speak the language before being able to buy property. It's intended to curb the number of second homes in some areas where it's become a problem, and if the plans go ahead, sellers will have to offer properties to locals for a set period before making them available on the open market. But over the years, we've seen lots of proposals to reduce demand and bring the property market under control when it's running particularly hot. Requiring people to learn Welsh is probably a pretty effective one as it goes.
It'd be pretty good. For Liverpool, we could do this all over the place. We could teach everybody Scouse if they want to invest there. I'll help you along, Rob. I mean, after all the years of me, you'd probably be semi-fluent. So, and then we can do all different regions. So I'll be struggling after Scouse, if I'm honest. Will this go through? Well, you never know. The world is a very, very strange place at the moment. I'm going with, I don't think this will happen, Rob. I'm not sure. You never know. In the past, I would have gone, this will never happen. But the way the world is today, I rule nothing out anymore. But who knows? We might have to be on Google Translate a little more frequently in the future if measures like this start going through.
Well, the Duolingo app is excellent. I've just checked. It does have Welsh on there if you fancy it. Another way to get ahead of the game is to attend our free webinars. We've got one tonight, actually. If you're listening to the podcast on the day it comes out, you can go to propertyhub.net/webinar. We're doing a session on what the property market is like right now, where it's going, what you need to know. We do one of these every month. It's completely free. So even if you've missed the one that's happening tonight, do make a habit of checking out propertyhub.net/webinar, because like I say, we do them every month and they're a lot of fun. On last week's show, we were talking about whether the property market is slowing down. We shared some data that's come out recently, and we talked about our own experiences in the market as well. If you haven't listened to the episode yet, strongly suggest you do so. Now, that was about what's happening right now. But of course, what everyone wants to know is what's going to happen next. If you knew exactly what was going to happen in the economy in the future, you could make a lot of money. Well, we can't promise that level of foresight for you. But what we can do is dig into the big questions that are on the minds of listeners to this show right now. And we know they are because they're contacting about us, which is what's going to happen next with interest rates and what does that mean for house prices? We've dug out some really interesting data. We've done a bit of analysis so we can share our views with you in this episode. So, Rob, I'm sure everyone is vaguely aware of what's going on right now. Everyone is very focused on the economy, more so than usual. Suddenly, economics is interesting again. But give everyone a bit of context for what's happening right now and why we're having this conversation.
It's great, isn't it? It's like we're not nerds anymore. It's like we're talking about something that's maybe going too far to call it cool, but of interest to people, of interest. So what's happening? Well, in case you've missed the news, inflation seemingly is out of control. It's double-digit territory. Depends on how you measure inflation. It will depend on how you get that number. And governments now seem to be doing their best to try and make that number look as small as possible. But even with their best efforts, it's still very, very high. And nobody in their right mind would suggest it's not in double-digit territory. And because of that, interest rates are on the up, not just in the UK, but also in the US as well. The Bank of England and the Federal Reserve are pushing up interest rates. And compared to recent times at a more aggressive rate than ever before. And both have made noise that they are prepared to put us into a recession to bring inflation down, which is very, very bold to say that. You know, it's not something you would expect them to say, to tell everybody that their lives are going to get worse financially so we can tackle this. But they are committed because they are scared of inflation. So, with all that being said, what happens from here? That's the big question, Rob.
It is, and it's nervy times because we, especially me, very publicly talked about on the podcast how we believe that interest rates will stay relatively low. So is it time to question that view?
Or ask for a refund on that book?
No, questioning the view is as far as we will go. But I think even that is currently unnecessary. And of course, that could change. There's always a scope to be wrong. New information may well come out that makes me reconsider my view, but it hasn't done so far. And remember here, we're saying relatively low. Interest rates have gone up, and it seems like a big increase when you're used to them being almost literally zero, but they still are very low. A base rate of less than 2% when inflation is heading for 13%, according to the most recent Bank of England projections, is still very low. Because that means that real rates, which is the rate of interest minus the rate of inflation, is still deeply, deeply negative. So rates are still low. And the big question is, how high would rates need to go to control inflation? And if doing that would have really severe economic and political consequences, would they do it? Let's say, and no one really knows what the number is, and you could question whether rates are that important in this at all, but let's say that the base rate needed to reach 5% to control inflation and bring it back down to target. If that happened quickly, that would have some very, very severe ramifications for all asset markets and the economy and jobs and everything else. So would they do it? I think that's highly unlikely. And I think we're in a really interesting political time at the moment as well, Rob, because we've got elections coming up in the US. We're on the verge of having a new prime minister in the UK. And of course, that means that politicians will want to be seen to be tackling inflation. Also, they'll be very aware that a deep recession and falling asset prices is a political disaster as well. So they're really in a tough spot.
They really are. So it begs the question, how much higher will rates actually go? Well, current inflation is mainly driven by the increase in money supply, or sometimes referred to as quantitative easing. So QE, or the money supply, mainly happened at the height of COVID. And after its 2020 spike, it started to come down. And that suggests that after a lag, inflation will come down on its own. So let's talk about swap rates. Now, I wanted to find a simple way of explaining what a swap rate is, and I asked Google to help me. And Google has said an interest rate swap is a type of derivative contract through which two counterparties agree to exchange one stream of future interest payments for another, based on a specified principal amount. So now it's clear. No, only joking. That is awful, isn't it? That's Google. Right. So basically, it's just the financial world's view of what's going to happen in the future around interest rates, and in particular, mortgages. It's a way of looking at what the markets think the future holds. Remember, there's some serious money at play in this industry and some serious minds behind it, far beyond what I understand, far, far beyond. But if you just see it as a tool for how the markets see the future playing out, then it becomes quite useful. So the current 1-year swap is at 2.7%, which is up from 0.1% a year ago. But the 3-year swap is also 2.7%, but it actually falls to 2.2% for a 10-year swap. So basically, the market expects interest rates not to go up that much higher and actually over the long term fall.
Now, I think this is really interesting because the question was, how much higher will rates go? And we've now got two separate ways of looking at it that are telling us the same thing. So the markets, in terms of swap rates, seem to believe that interest rates aren't going to go a lot higher and over the longer term will come down a bit. Then you've also got the fact that if you take the view that the inflation was actually caused by the increase in money supply, and you look at the fact that the percentage change in broad money has come right down again, that means that even if you did nothing, you'd expect inflation to come down, which means that interest rates won't need to go a lot higher anyway. And you can throw into the mix the fact that politically, people aren't going to be super keen on having rates going higher than they need to, faster than they need to, because even if they accept that a recession is necessary, they're not going to really want a recession to be any longer or deeper than it has to be. So put all this together, And I'm feeling pretty happy in my view that interest rates are going to stay on the low side. And we're not going to see what some people seem to think, which is almost like a return to the 70s where they spike out of all control.
And you know what, Rob? I'm actually pleased for society's sake, this is going to sound mad, that interest rates have gone up, because every time we've had a market crash, the Bank of England, the Fed, have used interest rates as a tool to help us get back on track. So they slash interest rates, bring lending rates basically to nothing, and therefore the economy is stimulated because of that. And that along with QE. Now, if this raise in interest rates hadn't happened and the next crash comes along in however many years' time, and they didn't have that tool to play with, it potentially could have put us in a lot worse position and therefore made it a far more severe economic crisis at the time. So if interest rates go up a little bit further from here, for the longer term good of us all, because of the way the Bank of England and the Fed tackle financial crises, it could be seen not actually to be that bad. Although, Rob, I always like to throw a positive spin on things.
No, I think you're right, though. As I talk about in the book, out now, there are so many negative consequences of rates being so low for so long. It's actually, the low rates in themselves are the cause of so many things that people are unhappy about at the moment. So, yeah, I completely buy into that. But let's move on, because why do listeners of this show care about interest rates? Anyway, if people have been listening to us talk about interest rates for the last 10 minutes, why? It's not because they've got a particular passion for this area, probably, and not because they're going to go and trade the bond market or anything else. It's because they want to know what it's going to do for property prices. And there is this intuitive view that interest rates rising means house prices falling. And logically, that absolutely should be the case. And right now, it probably is the case as well. We talked last week about the market cooling off a bit, various reasons for that, but one of the reasons for that, highly likely to be the fact that people's expectations of interest rates is rising, which is going to leave people feeling less enthusiastic about paying more and more for property. So I'm not contesting the view that generally you'd expect higher interest rates to mean house prices performing less well than they otherwise would have done. But I think a lot of people make the leap from that to crash. Interest rates going up means property prices are going to plummet. And I've gone back and looked at the data around previous periods when interest rates have been going up and had a look at what's happened to house prices during that time. And it certainly doesn't bear out the view that rates going up means house prices falling. In fact, if you look at every period since 1975 during which rates have been increasing, so during 1975 they went from 10% to 12%, between 96 and 98 they went from 5.9% to 7.3%. If you look at all these different periods, there's only been one of them where there was a nominal fall in house prices during that period. And I think that's really interesting because you can interpret this in different ways, but my interpretation is that the Bank of England was increasing rates at those times in response to the economy and therefore house prices being particularly strong, and that the rate rises that they made weren't enough to bring house prices down. Now, of course, you'll never know the counterfactual. It may well have been the case that they would have grown by more without the rate rises. That probably would have been the case. But what you can say, Rob, from going back and looking at the data, is that just because interest rates have started going up, you can't say historically, well, that means house prices are going to crash, because the data shows that historically they haven't.
So after understanding what it's going to happen to property prices, people always just generally want to know, well, what will happen next? Well, something that may have an impact, probably should have an impact on what will happen next, is our next Prime Minister. And as of yet, we don't have one. So at the moment, the two candidates in the running are Liz Truss and Rishi Sunak, and both have a slightly different approach to how they will tackle the economy. Now, Liz Truss seems to want to use stimulus as a way of sorting the current situation out. She doesn't call it that, but her policies are basically that. And Rishi doesn't want to do that. He is prepared to do a bit, but not as much. And that's because he believes, for what it's worth, I agree, that what Liz Truss has planned will cause more inflation. But it seems that because his policies are unpopular, basically saying to people, no, you can't have more money, and you can't have tax cuts, then he's starting to soften slightly on his stance, it appears anyway, from my eye. So maybe they'll both end up doing it anyway, just through political pressure. And let's face it, sometimes politicians will say things to just get in power. So let's see what plays out. They could all change their minds the day after they get into office. And again, based on what we've seen in the past, probably wouldn't surprise too many of us. But we do need to keep an eye on what our future Prime Minister does, because it could cause more inflation. Now, will that cause higher interest rates as well? Well, Rob, that brings us back to what will happen in the future. And are we going to see more inflation? And are we going to see higher interest rates? My view in the short term is yes to both. But in the long term, no to both. It's quite a simplistic way of trying to wrap this up. But in the short term, things will push on a bit more. But in the long term, it will all settle down and sort itself out. Now, you may feel differently, but my point of view kind of links to what we've always preached on the podcast is try and treat property investment, if you can, as a long-term investment. Because if you do, then this short-term noise, and it is a lot of noise, right? But this short-term noise is just noise. And in a few years' time, it will sort itself out. But of course, you could completely disagree, and that could make this quite a tasty end to the podcast.
Yeah, Rob, I completely disagree. Inflation heading for triple digits. Get your wheelbarrows out now to get the cash in. We're going Weimar style. No, I don't think we are. I do completely agree with that analysis. And for me, all the different data points we've looked at bears that out. But like I said earlier, you could always be wrong. This macroeconomy stuff is hard. It's really hard to predict. Extremely well-paid central bankers are wrong about it all the time. Nobel Prize winners are wrong about it all the time. What makes us think as a couple of podcasters that we're going to nail it where no one else has? I think you've got to be pretty humble about your ability to see the future, which is why I completely agree, Rob, that looking at property as a long-term investment and not worrying about all this stuff too much is the best way to go. To cheer myself up after spending a lot of time looking at things like swap rates, I went to look up some headlines from the past because I thought, well, objectively, the best time in recent memory that you could have bought property was the start of 2013. So by then, everything had bottomed out after the previous crash. Prices have leveled out. They just started to pick up and they're going to go on quite a nice little run. So start of 2013 would have been the perfect time to buy property. And yet, here are some of the headlines you would have seen at the time. The International Business Times had the headline, "Outlook for UK house prices remains uncertain," says Nationwide. And if you'd been reading This Is Money, you would have seen the headline, "House prices set to fall 1% in 2013 as London property market slows down." The point is that seeing what's going to come next is really, really hard. And as we covered extensively in the past, the media is always going to be an extremely poor guide to that. Because at the start of 2013, if you'd been paying attention to those headlines, they would have guided you precisely the wrong way. And that matters if you're doing something like a flip where you're trying to get in and out of the market quickly. You kind of need to be able to see 6 months to a year ahead and have a good idea of what's going to happen. But if you're investing over 5, 10, 20 plus years, then like you said, Rob, it is all just noise. And the best thing to do is just keep on doing what you would have been doing anyway.
So if you've made it this far into the episode, well done. And if you haven't already and you've made it this far into the episode, make sure you pick up Rob's book because, as you can see, you won't want a refund. You actually really should read it. It is important to understand this stuff because if you understand this stuff, it will give you confidence. And if you have confidence, you'll make better investment decisions. So make sure you pick that up. But it's time for Hub Extra now. And if you don't want to spend a few quid on a book, well, we've got something that's completely free and you can get inside Rob's mind with this resource. What is it? Well, we announced last week that Rob is kicking off his own personal newsletter through Property Hub. I'm super excited about it. The first one actually goes out tomorrow, which is great news. So if you are signed up to Property Hub already and get our emails, then don't worry, it's going to land in your inbox tomorrow. But if you haven't yet, you absolute nutcase, get over to propertyhub.net/news and sign up there so you can make sure that you get this newsletter as well. It's going to be a must read. I think it's going to be everyone's favourite email of the week. Rob, as you're probably aware, is a half-decent writer, and he kind of knows a couple of bits about property and finance and the economy as well. So with all that being said, it's going to be a great investment of, £0, it doesn't cost you anything, but a great investment of typing your email into a box for about 20 seconds, and then you will forever be rewarded. Now that is a great investment, Rob. A small bit of input with a lot of return week after week after week.
Much like listening to the Property Podcast, which you can do again, of course, next week. Every Thursday without fail, we'll be back with another great episode last week. We have so much fun recording these and hope you enjoy listening to them as well. As ever, let us know what you think. We're on all the socials at Property Hub UK. And we mentioned Portfolio earlier. You can find out more about that at portfolio.co.uk. For now, though, that's us done. Enjoy the rest of your week. Bye-bye.
Bye-bye.